Thank you for tuning into Talking Point. I'm your host, Niraj Shah. And on the show today, our guest is Vinay Jaising. He's MD of Portfolio Management Services at JM Financial Services. The questions that we hope to cover, or the topics of discussion today: does a bullish participant in the equity markets run the risk of a hawkish Jerome Powell today? Is India attractive post the correction seen in the month of January? View on commodities and steel in particular in wake of China reopening. Do platform businesses, which are now largely being ignored in India, offer value at the current multiples and prices? And can one expect a bounce back in pharma and specialty chemical stocks, or is it a long winter ahead for them? Of course, needless to say, we will also talk about the Dani Group because that's the center of conversation for the last 10 days and probably will stay that way for the next 10 before the market moves on from them. Let's get in Vinay Jaising on the show. Vinay, great having you. Thank you so much for taking the time out today.
Thank you so much for inviting us.
The pleasure is ours. So that's the conversation. The Fed has been trying to tell the markets that, hey, listen to us. We are telling you that we are not making a pivot anytime soon. The markets have chosen to believe otherwise in the month of January, the US markets, that is. Does the recent jobs data and the upcoming Jerome Powell address tonight kind of tilt the scales back in the Fed's corner of cautioning the markets properly?
So I think, this is, probably $1 billion question. At one end, you're getting data that there's red hot labor market. You've not touched such low employment rates of unemployment rates of 3.4% since over 4 or 5 decades. At the other end, you've had 500 plus K jobs coming in the last month. To beat it, Fed themselves are telling you that, you have two vacancies per job required. So, two jobs required. There are two jobs for everyone who needs a job. So there is too much of labor market. So the question is, if they have to get in control with inflation, the only way is to soften the job market. The only way is to increase interest rates, and the only way is to keep it higher for longer. So they don't believe, the world doesn't probably believe that there is a recession in US, which is why the 2-year and 10-year chart, though it is negative, you're seeing so much of demand on the labor front. So two contradicting signals, one on the labor front, and the second is the 2-year, 10-year chart. Having said that, what Fed has done by increasing the interest rates from 4.5 to 4.75, it's clearly told you that 5.2 is where they'll probably stop, and they'll maintain it for longer zone. Now, when you start maintaining it at a higher level and a couple of months pass by, that's when you'll start seeing the pain of people who have their reserves in place, be it net cash or a borrowing level which is low, and that's when the pinch will come to them. Now, I'll give you one more data point. M2 today for the world is growing at 0%, which last happened somewhere in 1995. Now, but the M2 today, the rate of growth of that has made the absolute M2 at least 20 to 25% higher than ever before. So that $9 or $10 trillion incrementally in the system is being sapped out to the tune of $90 to $95 billion per month by US. But it's a lot more money than it ever was. And the absolute M2 is keeping the firepower on in the US markets and globally as well. As you rightly put it, the world is looking at taking a risk on trade. So, your comment on the first part of your statement, which is the bullish participant, if you look at what's happened in the last month, or actually last 3 months, let's start with that. Just the news of China opening has got the Chinese markets up by 50%. The India markets is probably flat to down a bit. In the last month itself, Indian markets are down probably 4-5%. US is up 8 to 9%, and China is up 14 to 15%. So there's been a lot of risk on trade which has happened already. So the markets are not believing that we are in anywhere in a hurry for changing this trade. I'm not of that view, but I think the market is of that view for sure.
Let me then try and understand this better, Vinay. If that is indeed the bent of the market, and if there is a bit of a dichotomy between what the world markets are doing versus what Indian markets are doing as well, because we've seen that in 2022, we've seen that in the first month of 2023 in opposite directions. What does that template or texture hold for mean for Indian markets? What do we do from here on after underperforming for a better part of December and January?
So one point we need to also factor in is technical flows. India saw a lot of flows earlier, some point of time last year, but in the last 2 months, you've seen over $2 billion of outflows. You've seen Korea and Taiwan, which in my eyes are a play of China, seeing inflows come in of the same magnitude, each country, and you're seeing a lot of inflows go into China as well. Now, if I look at MSCI weighted of China, it's about 30 to 35%. One way of looking at it is at 30 to 35%, if the market is up 50%, have they now become equal with the people who are investors out there? Or because the Chinese market is down still 25% in absolute terms in the last 5 years, does the Chinese market have a lot more inflows which are coming? I think just because valuations in India touched 100% premium to emerging market, despite the correction, we are still at about 70 to 75%. So we are yet not over the woods on relative valuations or people finding meaningful money in other parts of the world. Now, put it the other way around. If you look at the currency trade, right, a simple currency trade, right, the DXY people, globally are pleased, probably seeing that the 115 levels are gone down to 101 and 102 levels. So there's been a 15% correction. The best performing currencies last year were the ruble, when we were discussing last time, if you recollect, as well as the dollar. Now, these two are probably the worst performing currencies in the last month or two. And the best performing currencies are last year's worst performing currencies. You add euro, you add any of the other names, Australian currency, Japanese, all of them have done better. India, unfortunately, at 81, 82 rupees to the dollar, has moved nowhere in the last 2 months. So really, it's going back to saying technically, places where valuations were exceedingly compelling and believing that the world is going to come back or limp back to normalcy. Let's forget the PMI data for now. 6 months or 12 months forward, the numbers will look better. There is so much value in the rest of the world. People are clearly looking at non-India and the risk on trade, not just China, but they're looking at just non-India, where the valuations are a lot more attractive.
When I must say though, at around the same levels that we spoke the last time around, you were bearish, and the markets actually rallied quite significantly, right? 17,400 odd. From there on, we went on all the way to 19,000. So, what gives you the? Firstly, what's your call therefore? If people are looking at other markets, does it mean that India relatively underperforms, or does India go down from where we are right now? That's part one. And what gives you the confidence that that is how it will turn out? Are there underlying factors which will support that call?
Sure, thank you. I was fearing that question, but thank you for that. So technically, if you look at the market today and look at the period of time we spoke earlier to today on the currency, and just assume you're a US investor, we probably went right, because if the currency is down 10 to 12% and the market today is at 17,400, you're at about 16,000 and change. But in that period of time, you saw the market move up and come back, to correcting down. So today, if you look at MSCI India dollar index compared to MSCI India, they too themselves have an 8 to 9% underperformance between them, which is the dollar has done worse. So currently for them, Indian markets on an absolute basis don't look too bad. They don't look too good, but they don't look too bad. So if I were to play an absolute trade for India, India's absolute valuation at 90-ish times or 20-ish times are back to their 5-year average. 10-year average, they're still about 10 to 15% below their 10-year average. So you're reaching a level wherein, on the bottom side, you've got probably a 10% downside. On the top side, you've got a 20% upside. So the risk reward ratio for India finally on the equity front is more on the upside than on the downside. Having said that, the next 12 months, we'll be talking a lot more on economic data, because you need to see how the recession is panning out. I just feel somehow the IT sector, the services space, that's where the job losses are. Even if you go back to your previous question of, US having a lot more job gains, but there are job losses in the IT space. So it's probably yesteryear economies which are hiring so many more people, and which is why you're getting number of jobs happen. So apart from that one space, you'll see everything else probably move up relatively better. And India is becoming a China plus one story. So for me, India is today an absolute market with a 12-month perspective of us looking at valuations going from 1920 now to 1 year forward to about 16 17. So you have a 10-12% absolute upside with a 5-10% downside. So that's really where we are as far as India is concerned. It's a stock pickers market. You've seen a lot of stocks which have corrected below their 52-week highs of about 30 to 35%. So I would be starting picking those stocks up today.
Okay, interesting. So let's try and talk through some of these things. Before I ask you about what is it that you might prefer, Vinay, so to say, two or three key points that are the largest topic points of conversations.
So
Firstly, metals. This they've come off from the levels that they used to trade at. But does a Western slowdown, if not a recession, thwart any kind of optimism around China reopening and a strong Indian demand, or are you constructive on metal stocks?
So think of it this way, right? Let's talk about commodities for a little bit because metal stocks depend upon how commodities move. We focus a lot on the prices of steel and demand of steel, but what if the price of coal has fallen far higher than the price of steel? So what
Mhm.
that means is your net margins for steel sector, which probably were at about 150 to 170 on the bottom, has moved to $250 a ton, and that's what's giving a lot more meat to the end operator, and he's going to earn a lot more margins in the next 2-3 quarters. And because coal prices literally moved up 100 and then 100, it moved up triple. So when it corrects down, people still make money on coal, but the prices of coal for your raw material go cheaper. So I think the trade in metal are two. The first trade is the demand growth probably incrementally coming up from China, which, though there is a recession, there could be some demand coming up there. But the second, more importantly, is the raw material falling down, which is giving you better margins. Now, remember, the balance sheet of all the Indian companies are far better in the commodity space than they ever were, right? So for us, metals is largely an equal weight stance because they're not as cheap as they were earlier, but the margins could be very attractive. And people, it's like you had inventory in the last 2 months of the last quarter which got over, so you couldn't see the results being as good as you would want to do it. But the next quarter you would see better results even if the prices are tepid. I'm not saying prices go down too much, but if prices are tepid and coal prices are down, your margins will do better. So that is why we would want to be equal weight. Something close to 3% is where we would want to bet our space as far as metals are concerned. We
Okay.
like aluminum and we like steel. So, you choose your pick, but, that's where we would be.
Yeah, and I think there was a news item last night that US is close to putting up a 200% duty or something like that, or banning Russian imports of aluminum, which might also feed into this story. Okay, so
Absolutely.
where is it that your largest overweights lie? Is it in proportion to the index, therefore banking, so on and so forth? And that is part one of my question. And roll into that, where is it that you are slightly contrarian in that the index may have an X weightage, but you have a disproportionately large or a disproportionately lower weightage?
So I was smiling when I saw your last question. So we are grossly overweight in the Make in India story. They happen to be some specialty chemical names and pharmaceutical names. So it looks that we are overweight in that space. The banking space is riddled with two. The financial sector, I would say, is riddled with two spaces. One is the banks, and the other is the associate financial services space, so the NBFCs. We are overweight in the private banks because that's where we think the loan book growth is fantastic. We like some public sector banks as well. The results are fascinating, to say the least. For the banking sector, you've seen one more quarter so far of results come out, seeing a 30% year-on-year growth. And what our analyst tells us is, this is just the start. The loan book growth of 17%. If you just look at that, that means you're more than increasing your loan book, even if it goes down by 1 or 2% more, by it's doubling in the next 4 to 5 years. So you're seeing an exciting loan book growth. Capex, which the budget has announced of late to be going up by 30 to 35%, is not yet trickling into corporate loan book growth coming in. So whatever growth you're seeing in the loan book is largely the retail sector. So once corporate kicks in, this number could be relatively attractive as well. And as the cost of interest is going up for the end consumer, somehow net NIMs are going up for the bank, because you typically don't pass on as much, or because of efficiencies, you get better yield on what you're trying to augur from the end customer. So we are very excited banks, but overall, because the financial sector is 30-31%, we are marginally overweight on the sector, though we are underweight the NBFCs and a lot more overweight the banking space. So that's on one part of it. The Make in India story, again, as I told you, give us a lot of good names which are purely, not depending a lot on China, but having their own production in India. And they are products which not available in the rest of the world, be it the fluorine chain or the bromine chain. And that's where, we are overweight, but that's a camouflage, because the weightage in the indexes are a lot lower in that. Where are we underweight? The IT sector, we are less than half. We are actually a third underweight, and we are increasing our weightage there, but more so in the large caps, because what we've seen is they've not cut jobs as much, or some of them have actually increased jobs. And interestingly, though we keep on saying, the IT sector is riddled with services problems in US, the profit growth of companies come out so far has been 9-10%. And that's virtually plus minus 1% of what it was last year or last to last year. So they're pretty, I shouldn't say it, but like they're like a consumer staple company. They're growing 10, in a bad year 9, and a good year 11. And valuations, for some of these IT names like Infosys are relatively compelling for you to look at it. So we are inching up, but we are quite underweight in that.
Interesting. And the equity just keeps on shrinking almost every second year when they keep on doing those buybacks. Yeah, pretty interesting.
So that's another way to give back money to the end customers. So that's why the return on capital employed always looks very, very appealing.
Yeah, it does. It does. The issue that I'm seeing with maybe pharma or spec chem is that while some businesses might be resilient, right, some of the most blue chip names are also finding it difficult to combat either the pricing erosion, supply chain mechanics, availability of raw materials, or a combination of all the three. And I'm not getting clear answers from the managements about when do they see the issue getting resolved. And on top of that, some of their guidances haven't quite lived up. So you kind of question whether they have a complete grip on how volatile the environment is. Could it be prudent to maybe bet once the numbers start showing up, or are you taking a bit of a leap of faith here?
Sure. So I think whatever you're saying is right, which is why we are not bullish. Most of the names you mentioned, most of the names we'll have in our space are not large pharmaceutical names. Virtually, we don't have any of the large pharmaceutical names. What we do have is very small pharmaceutical names where the formulation chains are very, very strong. I'll just give you one example, right? Think of a company, which every child, uses, like a cyclopam. Think of Indoco Remedies. Think of what we realize when we are using our air conditions. Think of the fluorine chain. Think of when we are sanitizing our hand, both fluorine and bromine chains. So we're looking at those companies which are probably mid cap and small cap in this space, which fit the bill for us for the Make in India story, and have a resilient export market, which is where we are attractive to. So the large caps we are avoiding for the same reasons as you mentioned.
Got it. Okay. Couple of more questions before we let you go. One of them is on consumer tech. Since we spoke about IT, the platform companies are just nearly forgotten. I was reading a note from one sell-side research today, which spoke about how some Sky Tower data seems to suggest that even the usage of the apps have seen a meaningful downtick. If urban discretionary demand is moderating, that's another impact. What gives with some of these consumer tech or platform companies by and large? Are they exhibiting value at the current levels, or is it still an avoid, or is it a buy? Who knows?
So, our perspective, when interest rates move up, hot assets will see the money moving out first, because your valuation criteria gets questioned. So we come from that school of thought that if you cannot value a company based on most of the conventional methods, it's just better to avoid them. Having said that, when you mentioned platform tech, I'm tempted to assume that even a Devyani, which is a QSR chain, which is working on the platform tech model, comes in that. So that's where we would be invested in stocks like that, wherein we can see visibility of profitability in the immediate or short term. and we can see them, increase their top line pretty aggressively. So those are the assets we would look at, but somewhere where we cannot see profit growth come up in the immediate being 2 to 3 years, we would totally avoid them.
Hmm.
Remember, the
So
cost of capital has changed altogether.
got it. So I'm not asking you to comment on a particular stock like Paytm, but I'm just asking you how significant could be an announcement around EBITDA before ESOPs, guided, done well and truly before, and the belief that now built on that, certain other stacks result in profitability coming sooner than later, and therefore start discounting those, be it Paytm, be it some of the others. How important would such announcements be for some of those companies?
Well, see, the problem is, when the question is so long and the answer gets complicated, that there will be easier ways in an era wherein the interest rates are moving up for you to realize how much of the profitability will matter for them. Now, as compared to that, I'm just going to give you another name. Let's just use a card company, a credit card company, right? What you're seeing in the credit card company is you're seeing the growth of subscribers of the card companies increase substantially. They had one part of business which relatively was not auguring them profitability, which was their debit card, or anything which you use in terms of UPI, or in terms of any kind of payment mechanism wherein you're using actual cash on hand. Now that part of it goes away. That means incrementally your return on capital employed there increases. You have an ROA of about 5%, and you got an ROC of 25%. So these are real data points. So unfortunately or fortunately, what the way we look at it is, if you can see a return on capital employed, if you can see high ROAs, why not buy them over any other asset class when the cost of capital is inching up by at least 150 to 200 basis points? So we're using the other argument, not saying that the quality of business would not improve for the Paytms of the world. They certainly will, based on the regulations coming up, based on the announcements coming up. But when you're seeing other asset classes where you can really look at evaluation metrics and they're appealing, we would want to put our eggs in that basket.
Got it. My final view, Vinay, and I'm sure you were asked by your clients as well all around the world about the whole event that took place around the Adani Group and the stock price meltdown that we saw. Now, what's your sense here, if you have a sense? By the way, standard disclaimer, viewers, Adani Group is in the process of acquiring 49% stake in BQ Prime, which is the platform that we're doing this conversation on. Be that as it may, Vinay, what is your view on what happened, the view on these stocks, if you have them, and the outlook ahead?
Sure. So what I'm going to tell you is what we own and what we probably owned a little bit earlier as well. So for us, again, it's all about fundamentals. Top down is important and bottom up is extremely important as well. We want to see a balance sheet. We want to see profitability. This is similar to the previous answer I gave you on, on tech platforms. If we cannot see the profitability in the next couple of years, there are times wherein we may not buy the stock, even if EV to revenues may look attractive. So there are two names or three names, linked up in this whole story of Adani, which has come up. One name which we like today is Adani Ports. Here and you're seeing an asset at 13, 14 times 1 year forward multiples. They have 21 ports. They own 20% of the overall port capacity of India with 30% of market share. They have a very good quality auditor. So we've kind of, in our parlance, in the investment team of ours, we like that asset class. We liked it earlier. It's cheaper. So, we bought more. We like it today. And it doesn't change the story for it being, one of India's biggest logistic companies. And India is a growing country. So that's something which we like, and we've ticked the box internally as well. The other company which we like, which got caught, which is not an Adani company, but which got caught indirectly, was Container Corp, because one of the contenders probably for Container Corp could be Adani, and Adani was supposed to be, and Container Corp was supposed to be divested. We like that company today. It's net cash. It's got 60 to 65% market share, both in import and exports. As far as the overall rail transport is concerned, you would appreciate rail volumes are the way to go for any kind of product coming into or going out of the country, because it's probably the cheapest mode of communication. So a huge monopoly, and going by the way the capex in the rail industry is happening in the next 2-3 years, we think the earnings also would be driven positively. So because the stocks corrected technically, it's something, a government-owned company got caught, this whole story. We like that name as well. The third is in the cement space. We mentioned your commodity story. So the way we look at the cement space is coal prices have come down, very similar to your metals story. Commodity coal prices have come down, but the final price of cement bags have not come down. So you could see 200-300 rupees per kilo advantage in the EBITDA for the cement companies. So if you're seeing some of the names which we liked earlier, be it in the Adani name, which have corrected, we are nibbling into them because when valuations are 8-9 times 1 year forward EV EBITDA, cheaper than the price at which even Adani bought it by about 15%. It's worth a look. They're cheaper than the rest of the world, and the earnings growth momentum in cement industry, courtesy the Indian budget, seems to be very robust. So these are the three names we are looking at pretty actively.
Got it. Okay. My final question: you reckon this nervousness because of what's happened in the last 10 days is now behind us, from a market's perspective? From a market's perspective, I mean.
Hope is a better word, because you're seeing too many things happen, right? At one end, interest rates are moving up, which we just discussed. At the other end, you're seeing red hot labor data, and at the third end, people are screaming recession. So I would say that every month is a new challenge, both on the macro front. I haven't seen so much of macro data ever change. There was a huge hiccup, which came in because of what happened to the Adani Group, which is clearly, I would say, shaken up a lot of investors. Just hearing about it is unnerving. Hope is a better word that it's behind us. We're looking forward to seeing what the final outcome is. But as far as we are concerned, again, profit is king. Cash is something we want to see, and we will buy those stocks wherein we can see cash. That's a much easier way for investors to make money in the longer run.
Got it. Well, it's the second time that we're talking to you, but it was as good or maybe better. Thank you so much for spending the time with us today, and look forward to having you more often on the platform.
Much appreciated. Thank you, team.
Thank you. And viewers, thanks for tuning in to this edition of The Talking Point.